So we'll go over the main economic data or news releases. These key economic data are specific reports that show an economy's health. These are the main ones in rough order of importance. Now, it does depend on the perception. Let's say if CPI is being watched by a lot of traders, if it comes in higher, now they're expecting rate hikes and we're already speculating on hikes, then this can make a bigger move. It all depends on the perception, but based on the size of the moves in general, roughly this is in terms of strength. You can see all this economic data on an economic calendar. The one I use is MyFXBook. You can use a bunch more. They're all online, they're all free. And essentially what an economic calendar shows you, the news event, the time and the date. It also shows you the impact. This is what people call red folder or high impact, which is just generally the reaction that you see, or you see mid or low. And then there's the consensus. So the consensus is the forecast based on different indicators by economists, analysts, institutions, reflecting the market's expectations. The consensus is what the market expects, and it is formed 1 to 2 weeks and can be revised from a change in sentiment, in monetary policy, or new data which changes the market's expectation. You also do have the previous result, which is just a previous result. In terms of the consensus, if the data comes in better than the consensus, it will always be green, and if worse, it will always be red. This doesn't necessarily mean it's good or bad for the economy. These are just colors assigned by algorithms. So high inflation isn't always good for an economy. It depends on the context or the market's perception. If this is on the back of a few months of higher inflation and market is already in fear of an economy overheating, then potentially you could see some downside. So the market often reacts based on how far the data deviates from the consensus and what the market has already priced in. We live in a speculation economy. The market is currently a reflection of the speculated. If an event or news changes the speculation, the bigger the difference compared to the expected, the bigger the move. So this analogy will help you understand consensus a bit better. So let's say you order pizza and you're expecting it to have 8 slices. 8 slices is the consensus. When it arrives, it will be green if it's more than expected, so more than 8, and red if it's less than expected. Now, obviously, with this example, most of the time, more pizza is good, but it depends on the context. So let's say if you're super hungry, then 10 pieces of slices is great. However, if you're on a diet, 10 pieces might not be as good. That's the same as consensus. But what about pricing in? Essentially, buy the rumor, sell the news. So pricing in is when market values price based on what it expects to happen. Investors use all information available to predict news outcomes. They buy or sell to match those predictions to be ahead of the news. A good analogy of this is the California fire, which happened a couple of months ago. Now, it is up for debate if it was an inside job or if it wasn't. I personally think it was. But let's say if you expect a fire to start in California, you will sell all your houses expecting prices to drop. Or if you're an insurance company, you will cancel all your policies as you've priced in the fire. If the fire does happen, you can now buy cheap land and avoid losses, and also avoid big payouts if you're an insurance company. If it doesn't happen, however, prices will continue to go up and you miss out on the gains, but also you miss out on insurance premiums. So back to the pizza analogy. So the 8 slices is the expectations. Pricing in is how you prepare for the expectation, meaning you might buy 8 plates, and if there are 10 plates, now you might need 10 plates. So there is a key difference between pricing in and consent. And this is a perfect example of the different dynamics of the news, but also the perception. And I think it's a great way of seeing how it's digested by price. So this was the initial hike in March. However, because it was already priced in, market was already expecting it. The flow has already happened. It was already priced in. Plus the dollar was also strong. It was also risk on, which did support more upside. So you did see a small reaction, but then price continued to push higher. Remember, if there's a rate hike, yen is likely to get stronger. USD compared to yen should go down if yen gets stronger. However, it didn't. Why? Because it was already priced in because of a strong dollar and also risk on. However, towards the end of July, we had soft PCE, which increased the Fed rate cut expectations. We also had leaks that there were potential rates that could come at the end of the month meeting, and then the market narrative changed. We then saw a risk-off market as hike expectations grew and the carry trade unwind began to unleash. This is when we actually saw the second rates. And yes, we were already expecting a hike, but it was confirmed. And on top of that, we were already in a risk off, which pushes money into yen. You've now got dollar, which is getting weaker, which is pushing UJ down. And on top of that, a few days later, we also got more weak dollar data, which increased the fears of recession. Essentially everything pushing UJ down. All the yen pairs sold off around 2,000-3,000 pips towards the end of July, and this is why.